Now, the free zone entities earning qualified income will have a 0% tax rate. And third condition is that they should comply with transfer pricing regulations. And fourth condition is that they should not have elected to pay 9% tax. These are the four conditions to become a qualified free zones, and in which case the profit will be taxed at 9%. The exempt incomes. The uh, generally the exempt income is mainly the dividends and other profit distributions. Dividends, other profit distributions earned from participating entities. What is participating entity? Suppose if a company or an entity is having an investment in other entities, wherein they are receiving profits, they are receiving dividends. In that case, those are exempted only if the investment should be 5% or more. The investment in other entity, the 5% or more should be the investment in shares or capital. In that case, the dividend or profit distribution received by the entity will be exempt from corporate tax. They need not pay tax on it. If they are having less than 5% of the investments and they are receiving dividend, then that is taxable. That should be treated as part of your profit, then that is taxable. The gains or profits earned out of sale of these participating interest, these shares will be taxed. For your information, this is not exempt. That will be taxed. Then the most important thing which you all people wanted to know, which is like the deductions. What are the expenditures will be deducted under the can claim the deduction under the corporate tax? The first one is whatever be the expenditure, if it is incurred for the purpose of business, it should not be capital in nature. Of course, if you are buying assets and those things, you will be claiming only depreciation, not the full amount as expenditure. All revenue expenditure in nature incurred for the purpose of business will be, you can claim deduction, except for certain things. One by one we'll see. First one, interest expenditure. If you are paying interest to banks or for any personal loan or whatever it is, all the interest will be allowed up to 30% of the interest expenditure, 30% of the EBITDA, sorry, 30% of the EBITDA, earnings before interest, tax, depreciation, and amortizations. The profit, the 30% of the interest only will be allowed as expenditure. Say, for example, your EBITDA is 100 and you have spent your interest expenditure is also 100 for that year. Then you will be having 0% tax, but it is not like that. EBITDA 30%, which is 30 will be allowed as deduction. Then your 70% of taxable profit less depreciation and amortization will be allowed as will be the taxable profit. On that you have to pay 9% of tax. This is called interest capping rule. Only 30% of EBITDA is allowed as interest expenditure. What will happen to the rest of the things? Rest of what will happen to the 70% of the unclaimed or undeducted interest, which you can carry over to the subsequent years. Up to 10 years, you can carry over those things and you can claim in subsequent years, the deductions. Then interest payments to related parties. Say, for example, you are getting a loan. If the entity is getting a loan from related parties, whether any deduction will be allowed. It will be allowed, but if the loan is received, if loan is received for the purpose of payment of dividend or profit distribution or repurchase of shares or capital contribution to your related party, another related party you are giving those monies, in those cases, this will not be allowed. The loan, related party loan should have been received, or that should have been not for the purpose of taking corporate tax advantage. That should be only purely for the purpose of business, and that we should establish that this is not to gain any advantage for corporate tax deductions. In that be the case, you can claim. Otherwise, it cannot be claimed as deductions. Then third one is entertainment expenditures. The entertainment expenditure in the nature of maybe you may be providing meals, accommodation, transportation, or any admission fees to clubs on facilities. Those things, if you are paying to customers, shareholders, suppliers, those things will be allowed up to 50% of the expenditure. If you are spending for 100, it will be allowed only 50% is allowed as expenditure. Remaining, you have to add back and pay the tax. Then the expenditures like donations, penalties, any bribes, profit distributions, corporate tax payments, VAT payments, any expenditure of VAT expenditures, not recoverable VAT. Other than that, if you're any VAT expenditures there, those things will not be allowed as deduction. Those things will not be allowed as deductions. Then most important things, these are all mostly applicable for those who are having related party and connected party transactions. The related party and connected party transactions always should be an arm's length price. The Corporate Tax Act is saying the entity should follow OECD guidelines. As per the OECD guidelines, there are 5 methods given to fix the transfer pricing, or the based on the 5 methods, one of the methods should be used, appropriate method should be used for transfer pricing or pricing between the latter parties. If any pricing between the latter party, one of these methods should be used. The comparable uncontrolled price method, cost plus method, resale price method, transactional net margin method, the transactional profit split method. These are the few methods they have, 5 methods they have defined in OECD guidelines. But anyway, you can in simple terms, you can see that it should be arm's length price. What is arm's length price? It should be at market level. Suppose if you are paying any of the remuneration to your directors, it should not be extraordinarily high. It should be at market level to perform that particular job. What would be the persons available at the market, at what salary you have to pay? That should be the salary of the or remuneration to the managing director or partners, whatever you are paying to them. In simple terms, it should be arm's length price. It should be a market value of the transaction price. Who are all related parties? Who are all related parties? 2 or more natural persons. If directors is there and who is relative, the director's relative up to 4th degree, it's a related persons, and one natural person, another one juridical person, maybe one entity company is there. If the both of them owns together 50 or more percentage, then that entity also will be related. If one person is a relative of another person and those person is having interest in the another entity, which is the related person, or both together having a 50% or more in those juridical person, then these are related party. And 2 or more juridical person also can be a related party. Entity A and entity B, if they are owning more than 50% or having a control over the other entity, then that will become a related party. Then who are all the connected person? Connected persons, as we discussed, it is like mostly the 4th degree of a person. Maybe if you're the owner, director, the related party of a director, related party of the owners, those people are the connected persons. The payment to the connected person should be at market value or arm's length price, as we discussed. Maybe if yeah, the payments to connected persons. See, suppose if when the entity is making a payment to a connected person, who is the shares of those uh, entities are traded in stock exchange, those things will not be called as a connected persons entities, because there is no, you cannot establish that 50% or more the ownership. For those cases, it is not the connected persons. They are not connected persons. Then comes to tax losses. The If the entity is having a accumulated losses, the before starting of the corporate tax, which cannot be claimed, the losses before the implementation of the corporate tax cannot be claimed. What will happen to the losses earned after the implementation of the corporate tax? Those things you can adjust in the subsequent years. Those losses can be adjusted in the subsequent year's profit, but that can be only up to 75% of the taxable income of that particular year. Say, for example, in 2024, the company is making a loss of 100, and 2025, the company having a taxable profit of 50. Then you cannot completely, the 50 cannot be adjusted against the losses of 2024, whereas 75% of 50, which is 37.5, you can claim as a, you can adjust the tax loss. The balance 12.5, you have to pay tax at 9%. That will become a taxable profit. This is for the tax loss of a particular entity. You can carry over to the subsequent years. There is no limitation of the years. You can carry n number of years and adjust against the future year's profit. But the one condition is there. There should not be any change in ownership, or there should not be any change in the business activities. It should be at least a similar business that entity should carry on, and at least 50% of the ownership should be continued for the subsequent years. Then you can adjust the tax loss of that particular year against the subsequent year's profits. Then we will talk about the tax group later, but before that, can if entities, later parties, those who are, two entities are there, one entity common ownership will be there. Example, mostly here in this part there will be common ownership will be there. There are two entities, one entity is having a profit, other entity is having a loss. Can we set off against these two? Yes, you can do, but there are certain conditions to it. The first and foremost conditions, at least 75% of the ownership of these two entities should be common. The 75% of the owner should be common. It should be either directly or indirectly, but the ownership should be common. Ownership should be there up to 75%. At least 75%. Sorry, not up to. At least 75% of the common ownership. Then you can transfer the loss of one entity to other entity and knock off the profit. That's the first and foremost condition to transfer the loss of an one entity to and adjust against the other entity's profits. What is the main condition? Important condition. 75% should be common ownership. The common ownership could be either directly or indirectly. And the none of the persons, these two entities, the person transferring and the transferring entity, should not be the free zone qualifying entity or exempt entity. And both the entity should follow same financial year and same accounting framework. In the sense, if it is IFRS, both the entity should follow IFRS. Mainly the three, or you can say four conditions. First one is 75% common ownership. Second one is you should not be a free zone qualifying entity or exempt entity. And third one is both the entities should have a same financial year. And fourth condition is both should follow the same accounting framing, which is IFRS. In these entities, both should follow the IFRS. Then we'll talk about the last one, which is tax group. Can the entities together and be like kind of a VAT group you are having it? But VAT group is completely different. Those things is not at all applicable. Here for corporate tax purposes, it is the entities can together form a group, but there are advantages and disadvantages as well. For that, to become a task group, 95% of the share capital or voting rights should be there. To become 95% of the share capital or shares in shares or voting rights or control should be or control 95% voting right and shares should be the same. In that case, you can form a task group. But to become a if you are becoming a task group, then you can claim only one deduction, which is 375,000. Together, as a task group, together you can claim 375,000 as the exempted income. It cannot be like the three companies together joined as a task group. Therefore, we will be claiming 375 into 3 together 1,075,000. It's not possible. That's not at all allowed. Only one deduction, which is 375,000, is allowed as exempted income. Balance, you have to pay the tax together. You will be arriving the profit together. You have to prepare a consolidated financial statements and you have to pay the tax on the consolidated taxable profit. You can have only 375,000 income. What's the companies under the group is severally and jointly liable for the corporate tax payable. All the companies should have a same accounting framework and same financial year as well. Then you can have a tax group. Of course, if you are not having a task group, you can claim 375,000 for each entity. And these things, each entity or each group should plan in advance. Accordingly, they can go for a task group rather than straight away going for seeing that advantage or disadvantage. You should have a merits and demerits analysis. Then accordingly, you can go for task group thing. Then, of course, the corporate tax is payable on the taxable income. How will you calculate the taxable income? How should you calculate the taxable income? The profit arrived at in the financial statements. The financial statement could be prepared either as per IFRS or any accepted standard, accepted accounting framework. You can prepare the financial statements wherein from the profit and loss account, you will be arriving at the profit. Whether it's an audited financial required, that's still not clear. We presume that it should be better if you are having an audited financial statements because it will that the profit will be vetted. It will be you will have an authentication on the profit figure around that. Okay, the profit as per the financial statements or profit and loss account should be adjusted for any unrealized gains or losses and exempt income. We talked about the dividend and other profit distribution from other entity investments. No more than 5% investments. If the company has received any dividend or profit distribution from those entities, that is exempt, that you can reduce. And transaction with related party and connected persons. If any adjustment is to be made, that should be made. These are the main three adjustments will be there. The first one is that the adjustments, the book profit should be adjusted to these three main elements. One is like any adjustment for the unrealized profits or losses. And second one is exempt income. Exempt income is maybe as we discussed one about that, which is like dividend or profit distribution received from our investments. The investment should be more than 5%. 5% or more should be there. In those cases, that adjustments you have to make it. And entertainment expenditure, interest capping, all those adjustments you have to do that. Then the last one, the transaction with connected party and related party, any adjustment needs to be made, that should be done. These are the few adjustments. Then you will be arriving at a taxable profit. Therein you can reduce you can adjust the tax losses. If it is previous year tax losses there, that you can adjust, but that tax losses should be after the implementation of the corporate tax. Then you can reduce 375,000, balance you have to pay 9% tax on it, which should be paid within 9 months from the end of the year. You have to pay the tax and file the return. And there is a relief as per the Act, small businesses, if revenue for a particular tax period and the previous tax period, if it is not exceeding certain limit, there are some relief is announced, but the threshold is not at all known to us now. It will be released later. We are waiting for the cabinet decisions. The once it is released, we will come to know what are those relief for the small businesses. So what is the threshold for the small businesses as well, small business relief. And other provisions which you people should know, withholding tax. One of the important thing, withholding tax. Withholding tax is like when you are making payments to a foreign entity for the transaction with your entity, then as per the UAE corporate law, if you are making a payments to income earned by the foreign non-resident entities, then you have to pay deduct withholding tax. As per the UAE corporate tax law, the withholding tax percentage is 0%. And foreign tax credit, if your foreign subsidiaries or any foreign branches, if those branches or subsidiaries pay taxes in foreign countries, then that tax can be taken as credit when you are include. But of course, you have to include those profits as well with your business income. Then you can take tax credit on those things. And the financial statements and their record should be, the books and accounts should be kept at least for 7 years. Record keeping should be kept at least for 7 years. And the changing of tax period, financial period, you can change it, but you got to make an application for the change of the tax period. And you should not do any transaction or arrangements that should, because of that, you should not take any corporate tax advantage. No, there's a GAR rule is there, general anti-abuse rule, that you should know. You should not have you should follow the same practice what you are doing it before implementation, same thing. But any adjustment in the systems or procedures and processes, that should not be like implemented for the purpose of taking advantage of corporate tax, to eliminate the corporate tax advantage. Then those cases should not be allowed. And transfer pricing documentation, if you are having a transaction with related parties and connected parties, then of course this documentation you should maintain it properly, exclusively. Maybe you should maintain proper master file and local files. Those things should be submitted to the authorities within 30 days from the date of request. This is clearly given in the corporate tax that you should, those who are having a group companies, it's one of the important thing that they should take care of it. With that, I am ending this presentation. Those who are having the questions, what you can do, you can unmute yourself and ask the questions. We will address those things. As we discussed, we have completed this presentation in half an hour's time. Your questions, all those things welcome. We will be addressing it. Maybe another 15-20 minutes, we can continue these question and answer sessions. Those who are having questions, please unmute and we will address it. With me, Mr. Gobag also joined. He will also address those questions. Thank you.
Hi, good afternoon. Yes, whatever questions you guys have about the corporate tax, so you can raise it so we can discuss. We will try to, with the available information, we'll try to clarify your queries. Yeah.
For your clarification, for the corporate tax will be applicable for those who are having the financial year starting from 1st January 2024 and ending in 31st December 2024. your corporate tax is applicable from 1st January 2024, which means you have to pay corporate tax on 2024 year's profit. I think no more questions or anything.
So everybody is.
If it is thorough now there are few times. Even if KGRN staff has any questions, you can ask.
Anyone, you could raise your doubts. Yeah.